might say what's proposed means. Well, proposed regulations means that the IRS puts it out there and then asks for comment letters back. So the public, industry groups, law firms, CPA firms, anyone affected by these regulations can write comments into the IRS and the Treasury Department, letting the IRS and Treasury Department know how the regulations work, maybe how they don't work, what are some of the unintended consequences maybe that the IRS didn't consider. And then there's a public hearing, and then hopefully the IRS hears the comments and perhaps adjusts the regulations appropriately, and then regulations are issued in their final form. And the latest word is that we hope to have the final regulations by the end of the year. So this is going to go very quickly. Proposed regs in August. We're going to have a hearing in October. We'll have comment letters. We'll already see comment letters coming through, and then final regulations sometime maybe in November, December. So this is briefly here, this is the structure of this proposed regs. So it's 190 pages of regulations, I think. And some of that's descriptions of how the rules work, some of that's definitions and so forth and examples. But the -1 part of the regs gives kind of how the rules operate generally. -2 talks about how you determine your share W-2 wages and unadjusted basis. And we'll explain why these things are important in a second. If these terms aren't ringing a bell, don't worry, we'll get into it. -3 talks about what is qualified business income. -4 provides rules for how you can aggregate various businesses together for purposes of the deduction. -5 tells us what is a specified service trade or business. That's generally bad under 199A. You don't get the 20% deduction, but we get some helpful guidance from the IRS on what it means to have a service business. And then -6 provides rules for what are called relevant pass-through entities, a new acronym for us all to follow, RPEs, publicly traded partnerships, trusts, and estates. And all of this, we'll work through this during the hour that we're going to be with you here. So again, if this isn't ringing a bell, don't worry. We will get into it in depth.
Well, hi everyone. This is Mac, and welcome. Before Adam gets into the details of the proposed regulations, I thought I'd provide just a high-level summary of how to calculate the 199 Cap A deduction, probably more as a reminder. But basically, the deduction is 20% of qualified business income. We'll use the term QBI. Regular C corporations don't qualify, but most other taxpayers do. So individuals, estates, and trusts qualify if they have QBI reported, for example, on schedules K1, Schedule C, E, F, that sort of thing. You compute the deduction for each trade or business and then add them together. Now, for taxpayers that have taxable income above the so-called threshold amounts, the deduction can be limited to the greater of 50% of W-2 wages of the trade or business, or the sum of 25% of the W-2 wages plus 2.5% of qualified property. So, simple example, we have a trade or business that has QBI of $100. We'd first say, well, we ought to get 20% of that, or $20. But then if that trade or business only has wages of $10, and no property, for example, we'd just take 50% of the $10. We'd say, okay, we are limited to $5, and $5 would be the deduction. Now, these limits phase in starting at a threshold amount of taxable income, and that's taxable income before the 199A deduction, and that those levels or those thresholds depend on your filing status. So if you're married filing joint, the limits don't apply if you have taxable income up to $315,000, and then the limits phase in over the next $100,000 and fully kick in at taxable income of $415,000. If you're anything else, single, married filing separate, trust, or an estate, the limits don't apply to taxable income up to $157,500, and then the limits phase in over the next $50,000, so they fully kick in at $207,500. Now, these threshold amounts are also important when we get into specified service trades or businesses, or what I may refer to as SSTB, or service business. And Adam will talk about that later. In addition, you can also get a deduction equal to 20% of qualified REIT dividends and publicly traded partnership income. The deduction's available regardless of whether you're an active or passive owner of the trader business under the passive loss rules. Those are just basically disregarded. And then there's a final overall limit to the total deduction that's 20% of taxable income before the 199A deduction, but excluding net capital gains, and that includes qualifying dividends. So a lot going on, but depending on where taxable income is, this can be a very simple calculation or it can be very complex. Probably the last point would be that the deduction is temporary. It disappears after 2025, which can make planning a little tricky.
Okay, looks like we're at our first polling question. So, the first question, do you or your company expect to qualify, let me get rid of this so I can see, there we go. Do you or your company expect to qualify in whole or in part for Section 199A deduction? And let's open the poll. We will keep that open for about 30 seconds. Ready? There you go. Can you all see that? Yep, perfect. Just a few more seconds on the poll if you want to put in your answer. Okay, we're going to close the poll now. All right, and there are the results there. So 61% said yes.
Interesting. So that's not surprising that most of the people here have decided to attend the webcast. Obviously, if you're attending the webcast, you think you probably have some inclination that may be affected by the deduction. So also interesting that the second biggest group is not sure, and that could be people wondering whether they have a qualifying business. Maybe people are wondering whether they'll be limited in one fashion or another. So interesting results.
Okay. I'm going to mute myself and
Adam, it looks like we skipped over that non-qualifying income. Do you want to go back to that or just keep going?
Yes, we'll go, sorry. Well, we're having an issue on that slide, but I can take that.
Okay.
So generally non-qualifying income is, they don't tell us what QBI is. So we want QBI, as Max said. Instead, they tell us what QBI is not. And the types of things that QBI is not are typically what you think about as investment type income, capital gains, dividends, interest income, so long as it's not from a trader business, commodities gains, types of things that we typically think about not coming from a trader business, from investment activity. Also, interestingly, 1231 gains, those are gains from the sale of business property. There's a special provision in the code that treats those as capital gains, and maybe not surprisingly, those capital gains are not included in QBI because they already received the preferential tax rate, but 1231 losses do reduce QBI because 1231 losses are generally ordinary income. We expected this result. There was some debate about how 1231 gains would be treated. It's not surprising the result there, considering that 1231 gains are capital in nature and that the losses are ordinary in nature. But probably the bigger category that generated all of the buzz pre-regulations was what Mac referred to as an SSTB, or a specified service trader business. Again, we're in the category here of businesses that don't qualify. So if you have this type of business, you don't get the 20% deduction. And what's indented here in this paragraph are a whole bunch of different types of businesses that don't qualify. And you're going to see health, you're going to see lawyers, so doctors, lawyers, accountants, athletes, people involved in the financial service industry, and so forth. All of that is bad. And then the last phrase was what generated all the buzz, because it was any trade or business where the principal asset of the business is the reputation or skill of the employees or owners. And we're going to get into this later in the slide deck, but this generated all the buzz because you could really look at that language in red and think it could apply to any business in America. And so everyone was looking to the IRS to say, hey, you need to give us a definition of this part in red, and hopefully you come up with a definition that doesn't swallow every business in America. And then, as Max said too, even if you're a doctor, even if you're a lawyer, if your taxable income is below a threshold amount, which is the $315,000 for married, filing, joint, and about $157,000 for single filers, you still get the deduction. But that's only for your business income from that law practice or your doctor practice. W-2 wages do not qualify. Guaranteed payments do not qualify. So if you're a doctor receiving a W-2 wage of 100 grand or 200 grand, none of that will qualify. But if instead you're a doctor and you're allocated income from an LLC taxed as a partnership, if your taxable income's below this threshold amount, you may qualify for the 199A deduction. So I'd heard that I wish these questions were my own. They weren't. I was attending a conference earlier this spring, and someone had phrased two large questions that were raised by 199A. And there's lots of questions. You could come up with 20 questions, but maybe the two biggest questions were, one, what is a business for purposes of Section 199A? And then two, what is a specified service trade or business? And luckily, with the proposed regulations that were just put out that we're talking about today, we have answers to both of those questions. And the first question is, what is a business? Because if qualified business income, is the middle word in that is business. And it says, well, what is a business? And the IRS said that they're not going to create a new standard for 199A for what a business is. They said instead that they're going to look to the traditional definition of what is a trade or business under Code Section 162. And that's helpful in a way, and you can understand why the IRS did that, because Code Section 162 has been around since the early 1950s. And so there's 70 years of case law, there's regulations, there's rulings from the IRS. There's a whole body of law that we can look to help understand what a business is under 162. So it's helpful in a way that they relied upon a definition that we're all familiar with and accustomed with. Also, interestingly, the IRS said it doesn't have to be entity specific. So you could have multiple entities, and when we say entities, I mean LLCs, partnerships, LLPs, and so forth, as long as they're not C corps. But any non-C corp, any entity that's not classified as a C corp, you could own 3 different LLCs, and that could be considered one business. You could also own one LLC and have multiple businesses under a single entity. And this is relevant because for each business you're going to have to separately track QBI, you're going to need to track your wages, you're going to need to track the basis of property, and report all this up. And we'll get into this later on in the slide deck. But if you're wondering why does it matter if you have one business or multiple businesses, it's the fact that you have to separately track all of this information on a business by business basis. And so there's some factors we put on the slide. These are in no way exclusive. If you go back and read the case law and so forth, you could probably come up with many more factors indicating whether something is a separate trade or business. But here's a couple of things we thought about. One, if you have different employees and different management chains, we tend to think you have a separate trade or business. Separate locations, that maybe indicate a separate trade or business. Distinct legal entities, even though it's possible to have one business over multiple entities, to the extent that you have businesses segregated in different legal entities, and legal entities, I mean state law legal entities, LLCs and so forth, maybe that shows it's a separate trade or business. And then also, do you have separate books and records and accounting protocols for these different businesses? But again, what I think we want to emphasize today, and hopefully the takeaway for you is that there could be many other factors. And really, it's what we call a facts and circumstances analysis, that there is no objective standard out there. So for each business, it's a subjective facts and circumstances test, and trying to figure out whether you have a single trader business, multiple trades or businesses, and so forth. So if 162 generally, I said that it's a standard that we're all familiar with and can rely upon, the one problem under 162, and this is not a new problem under 199A, this has been a problem for a long time, is it's very murky what it means to have a rental trader business. So normal businesses, I think we can all kind of know it when we see it, perhaps. If you have a construction company, or you have a management company, or whatever you or a real estate company, whatever you're doing, it's pretty easy to say that's a trader business, that you come to work 9 to 5 and have employees and you manage it and you're trying to make a profit, and it's not difficult to see that's a trader business. The problem is, what happens if you own a piece of property and you rent it out to a tenant, or you rent it out, to either a residential or commercial tenant? Is that a trader business? And it's just not totally clear what factors are necessarily relevant to look at to determine whether you have a rental trader business. And this is important for 199A because rental income can qualify for the 20% deduction. It doesn't automatically qualify, but it can qualify. And the operative thing to look at is, does the rental income come from a trader business? And if it does, it could qualify. Or does the rental income come from kind of more of an investment activity or something else that's not a trader business, in which case it wouldn't qualify? And no doubt you're looking at your monitor now and saying, what's this guy talking about? How can you tell the difference between renting something as a trader business versus renting something as an investment activity? And again, I just emphasize it's not totally clear. And we were hoping that maybe the IRS would give us some rules in these proposed regulations to help us figure it out, or maybe to give us another standard, or to give us a hint on which way we should look. And instead, the IRS really didn't say anything other than you just look to the traditional definition of 162, which is murky. But here's again some factors to consider. Like previously, these are by no means exclusive, but the scale and number of properties involved, if you're renting 30, if you own 30 pieces of property and renting them out, that maybe looks more like a trader business than owning a single piece of property and renting it out. Although it is possible you could have a single piece of property and that could be a trader business. It could also be relevant how involved you are with it. Now, that doesn't mean involved is not being passive or non-passive, and there's no special real estate professional rule. But if you're coming by your property every month to make sure your tenant hasn't burned it down, and making sure the lawn's mowed, and making sure the furnace works, and doing all that, maybe that looks more like a trader business. Also, there's discussion out there, this is not in the proposed regs, but there's some discussion out there about if you have a triple net lease, where basically the tenant is responsible for all material expenses, and the landlord more or less sits back and collects a check. Maybe that looks less like a trader business, and maybe that looks more like an investment activity. But then again, too, if you have triple net leases, but let's say you have 30 different buildings or 50 commercial buildings all on triple net leases, you might say even though they're on triple net leases, surely that could come close to rising to the level of a trader business. And so then you might look to some of these other factors. So none of them are conclusive on their own. It's just some things to look at. And so we put this example out here. It's an example we at Eide Bailly have been thinking a lot about because it's undoubtedly a question we're going to get next year over and over again as we prepare tax returns next spring. And the fact pattern, and it may be people out here listening to this webcast now, or people may know people, but the fact pattern is going to be very common is someone has a full-time job that has nothing to do with real estate, and they own a house on the side, a single rental property on the side that maybe it's their previous full-time residence that they moved to a new home and they kept that home, and now they're rented out to a tenant, and it generates $1,000 of positive income every month. And their question they're going to come back to their tax professional with is, do I get the 20% deduction for that? And it's a hard question because there is you can't automatically say, yes, it qualifies. You can't automatically say, no, it doesn't qualify. And you would look to some of the factors we already talked about. You know, you might also look to say, how involved is that client with managing the property? I mean, there's no magic time. The client doesn't need to spend 500 hours a year, 1,000 hours a year, but how directly are they involved with managing it? Do they pay someone else to manage it? And that could be a bad fact, but there's also a case from 25 years ago that says even if you hire someone else to manage your piece of property, they can still qualify for the trade or business. So if you're frustrated and say, this is making no sense, we're frustrated too. It's very difficult to figure out what it means to have a rental trade or business. And so I think we'd emphasize it's a facts and circumstances analysis, and you should be talking with your tax professional now about the existing situation and whether what you do, if you have a rental activity, whether that rises to the level of a trade or business. Also, this is again the question of what is a business. One of the other questions was, is it possible to aggregate various businesses together? And we have existing rules that let us do that under Code Section 469. It's called the grouping. You can make a grouping election to group various activities together for purposes of the passive activity rules. The new 199A regulations do have an aggregation rule. They don't look to the 469 rules. They create a brand new standard and say that you can put businesses together and treat them as one trade or business, as long as none of the trades or businesses are a service business. So you can't aggregate a law firm with a manufacturing firm. You need majority common ownership, which is 50% or greater, and then you need 2 of the 3 factors listed below. So we need to satisfy point 1, point 2, and then 2 of the 3 factors listed under point 3. And either there's common products and services between those trade or businesses, shared facilities or shared centralized business elements like personnel, back office functions, HR, etc., or the businesses are operated in coordination with or reliance upon other businesses. And the regulations say supply chain interdependencies. And the question you might have is, well, why does this matter? Why would I want to aggregate? Well, aggregation may be helpful because if you have wages in one business and no wages in another business, if you can put those together, then you can use those wages to potentially satisfy the various 199A limitations for both businesses. Also importantly, if you are a shareholder in an S corporation or a partner in a partnership, or if you're the manager of any of these entities, the entities themselves cannot make this aggregation election. Instead, what they have to do is report all of the information on a K-1 and then allow shareholder and partners to aggregate. The aggregation is done on the individual taxpayer level. So a whole bunch of additional compliance considerations here, that if you have 2 or 3 different trades or businesses underneath an S corporation or a partnership, you're going to have to separately report the various items of income and wages and basis and so forth on the K-1, and then provide also enough information up to your shareholders or partners to allow them to make the determination on whether to aggregate or not. So
I might just, I'll just cover a couple of examples quickly here. So this first one is an example that illustrates the potential benefit from opting to aggregate trades or businesses where the requirements are met. And you can really look at the details later, but the key is to note that there's one business, Y, with a lot of income but no W-2 wages or property, and another business, Z, with little QBI but lots of wages, sort of the circumstance Adam was talking about. Next slide, Adam. Just go to that. And when we go through the calculations on a business by business basis, we get a total deduction of $200,400. And note that business Y is limited to 0 because of not having wages. We can go to the next slide. And then if we choose to aggregate the 3 businesses, the additional W-2 wages of business Z, the business that has the little amount of QBI, cause the total deduction to increase by $200,000 in this example to $400,400. So just illustrates the potential benefit of aggregation. Won't always be advantageous to aggregate, but certainly something to keep in mind and to do if it's favorable. And oh, go ahead, Adam.
Yeah, I was just going to say, so really here with the taxpayer didn't have to change anything else. All they had to do was make an election to aggregate, and they doubled their 199A deduction just with that election.
Right. And I think one thing to keep in mind that complicates things a little bit is once you aggregate, you're pretty much stuck aggregating in the future. So it's not a year in, year out decision. You need to look out into the future and decide what is the best thing to do. This next example is one that shows G and H who have common majority ownership of 3 businesses. And these businesses have shared common elements and are operated in coordination with one another. So aggregation is a possibility here. Next slide, Adam. The analysis on the slide points out that both G and H, as members of a group with control of each business, can choose to aggregate. And that's sort of an interesting result. I think I might have tended to think prior to the proposed regulations that if there was aggregation, only the majority owner, G, could aggregate, but it's looked at as on a group basis. And so again, interesting possibility. Minority owners in situations like this, if they're minority owners in multiple businesses, will need to know the ownership in other entities to determine whether they're part of a group and be able to aggregate. So again, more information that will be needed.
Yeah, it's an interesting point that H there in that example, G owned 80%, and it makes sense G could aggregate, but H has no relation to G, and all H does is own 20%, but H can look to G and say, well, G has common control, and I can use that common control to aggregate myself. So, but also to Mac's point, if they're not related, how would H even know that G owns 80%? So is there some obligation there back to those various LLCs and S Corps to notify the partners and shareholders that there is common control? So all things that we'll be working through this fall and then next year as we prepare tax returns. So the other is continuing along this theme of what is a business. There's a concept out there that's been out there for a long time called a self-rental. And the idea of a self-rental is that you have 2 entities under common control. One entity is operations and one entity owns the real estate. And a lot of times the terms we use for operations is OpCo, and the entity that owns the property is PropCo. And it's a very common that people put the real estate in a separate and distinct legal entity from the operations for various state law asset protection purposes or to limit liability. It doesn't really have much, it's not necessarily a tax planning idea so much as it makes sense from a state law perspective. So the question is, and typically usually the PropCo, the building owned by the PropCo LLC is exclusively used by operations. So it's the construction company whose operations are an OpCo, and the construction company operates in a building, or maybe the construction company has a yard with all of its trucks and so forth, but that property is owned in a PropCo. And so there's a lease between OpCo and PropCo so that operations pays PropCo for the use of the property. And so PropCo is generating income from that. And this is not a new concept. This has been around for a long time. But the question is, what is that? That income that OpCo pays to PropCo for the use of the building, that rental income, what is that? Is that trade or business income? Is that something else? And the concern is that it's very easy to manipulate that because it's under common control, that OpCo can choose to pay more rent or less rent. If it pays more rent, there's more of a deduction at operations side, and it pushes more of the income to PropCo. Or if it pays less rent, there's less of a deduction at operations side and less income at PropCo. So you could game it if there was some advantage to pushing all the income to PropCo. You could game it that way, and you could also game it if it was more advantageous to have income at the OpCo level. So what these new rules say is, in this situation, if you have common control and you're renting or licensing tangible or intangible property between an operations, between a trade or business, that all of the income is treated as one trader business. So in my example, and I think this next slide shows it, well, we've got a polling question first, but we have an example after our polling question that kind of illustrates this. And what it says is the income from OPCO and the income from PropCo is one single bucket of income, and it is one trader business. So it doesn't really matter. You can push all the income to PropCo, you can push all the income to OPCO. It doesn't change the overall result. But Amy, I'll take polling question 2 here if you just want to help us through it. So, the second polling question is, do you expect your Section 199A deduction to be limited by the rules? And Matt covered those a little bit, and we're going to cover them some more, but there's these various things that could limit your deduction, wages or basis or not enough taxable income. Do you think that your 199A deduction will be limited? Yes, no, not sure, not relevant.
Awesome. While they are filling out that polling question, we do have about 10 questions in the question box. Would you like me to wait till the end of the session, or do you want to do this? Yeah,
let's wait till the end. And I'm happy to stick around. And I won't speak for Mac, but in the past, what we've done is stick around after the webcast to get to the questions, because we still have quite a bit of material to get through in the next 25 minutes. But we'll stick around afterwards to go through those questions if people have time to stay with us.
Sounds good. Okay, you should be seeing the results of the poll.
Yeah, interesting. So a mixed bag that I guess the majority, or not the majority, but the most common answer is that people will be limited to some extent, but then some people not sure and some people no. So I guess to the extent, even if you think you're going to be limited or don't think you're going to be limited, I would definitely go talk with your tax advisor now this fall before busy season starts about kind of the current situation, and maybe there's some modeling you can do, and maybe there's even some planning that can be done to minimize that if you think you're going to be limited. So this is the self-rental example that I was going to get to here. Again, remember we're talking about OPCO, got OPCO on the right, and then you have real estate entity on the left, and we have greater than 50% common ownership between the two. And what these new proposed rules say is that's a single business. So again, you can push all the income to the real estate entity if you want. You can push it all to OPCO. Doesn't matter, because you're going to get to the same number. And also helpful maybe perhaps if you have a bunch of wages in OPCO, you can use those wages for the limitations tests for the rental income. But on the downside, if OPCO, let's say OPCO is a doctor group or a lawyer group, it's a law firm. Let's call OPCO a law firm, and it's renting its building that exclusively uses from the real estate entity. Unfortunately, then that taints the rental income. So you have law firm renting from the building, and to the extent that rental income is from the law firm, then all of that income is viewed as service-based business and taints it all. Also, it's helpful, if you're generating a loss from the real estate entity, then it's going to be reducing your OPCO income. Whereas if you're generating positive rental income, then it's going to increase the pot of income eligible for 199A. Maybe less of an issue really if everything's under common control and you can dictate what rent is. Maybe less of an issue there, but still something to think about. So that kind of covers the first. If you remember in the beginning, I said the two big questions I had heard at a conference and it kind of resonated with me were, one, what is a business for 199A, and then two, what's a specified service trader business, an SSTV. And if you remember when Mac gave us the quick intro to this, it's bad. You don't want a service business. I mean, service businesses aren't bad outside of 199A, but for 199A, if you have a service business, it means you don't get the 20% deduction. So it's I call it bad income or non-QBI income. And it's this last phrase here. It's this: any trader business where the principal asset of the trader business is reputation or skill of one or more of its employees. And the example I always use is, what about Bob's Landscape Service? That people hire Bob to come to their house to mow their lawn, to spray for weeds, to do what Bob does in his business, and they do it because they know Bob's going to show up on time. They know Bob works hard. Their neighbors have used Bob. Bob has a strong reputation in the community. Does Bob have a service business under this definition? And the answer is surely no. Bob can't be in the same bucket as CPAs at Eide Bailly or law firm partners who practice law. And fortunately, the IRS, I think, agreed with that, thinking Bob should get it. And so the IRS took a very narrow definition of what this means. And it really only relates, for the most part, to people that make money either by endorsing products or by licensing their name or their likeness, or receive appearance fees. I mean, really, it's probably too much of a blanket statement to say famous people, but that's probably the majority of people that will be caught up by this are, you know, actors and athletes and so forth, people that make money from their likeness, from appearing at events, from licensing their name and so forth. If you're not in those three buckets we're looking at there, you don't have to worry about this last phrase. You have a good business. So Bob's Landscape Service, Bob is A-OK under this. And the IRS really, when they came up with this narrow definition, the IRS recognized that 199A was enacted to provide really a broad-based deduction from taxable income to businesses that are not C corporations, because the C corporation rate was dropped from a high of 35% to a flat 21%. So 199A was passed by Congress to give not necessarily comparable tax relief, but to provide tax relief to businesses out there that are not C corporations. So the IRS recognized that and said, you know, based upon that, we don't think it's appropriate to come up with a broad definition of a service business. We came up with a narrow definition. So good news for taxpayers. Also, in the beginning, when Mac was walking through it, and I think I touched on this too, is that we had this listing of 10 to 12 specific businesses that don't qualify, law firm, et cetera. And some of the questions always were, well, how broadly are these terms interpreted? You know, to be a lawyer or to be involved in the legal profession, and what does that mean? And what the IRS said is that they are adopting the commonly accepted definition of these various businesses, and they're looking to existing guidance under 448, section 448. So for example, legal services is not only income earned by lawyers, but it's also income earned by paralegals, arbiters, and mediators. You know, similarly, accounting services, it's not just CPAs. It can also include tax return and bookkeeping services. The one category here that maybe we worry about sometimes is consulting. And what they said was consulting means the provision of professional advice and counsel to clients to assist the client in achieving goals and solving problems. And I think there's a question there of breadth, because it's hard to put your hands around exactly what it means to be a consultant, and that phrase is maybe a bit nebulous, and you worry there's a lot of people that are doing things that kind of seem like consulting, and it's hard to get a high degree of comfort that they're not necessarily consulting. So lobbying is actually a specific example of a consultant. So if you're lobbying Congress or lobbying governments on behalf of clients, that's consulting. Financial services is another bad category, meaning if you're considered to generate income from a financial service business, that's bad. But the IRS narrowly defined that. They generally excluded banks. They're really looking at people that manage wealth and finances for clients, or provide what we call advisory services, you know, relating to M&A deal, mergers and acquisitions deal, evaluations, and people involved in raising capital. So in the industries impacted, you're looking towards financial advisors, investment bankers, wealth planners, retirement advisors, and so forth. Banks generally excluded, although there are some question about, you know, some things banks do, whether all of their lines of business are excluded. And then investing and investing management, if you're involved in managing other people's money or assets, that's bad. Examples of that would be if you receive flat fees, commissions, or management fees. That would be indices of having an investing and investment management business, which does not generate QBI. However, if you're managing real property, day-to-day real property, so making sure that the rental building, the roof doesn't leak, and making sure that the heating works and that the lawn's mowed, that's okay. It's more if you are managing people's money and making sure that the money is invested wisely into a particular asset, and that asset happens to be real property, that would be considered a service-based business and involved with management services that would generate non-QBI or bad income. Traders, dealers, and then are also don't qualify, and then brokerage services don't qualify. And helpfully, real estate brokers are okay. So brokerage services really is focused more on people involved in the financial services space, so stockbrokers and similar professions. Doesn't include real estate agents and brokers. But then I highlighted there the concerning category there of consulting. What if a real estate broker also provides consulting services? And we don't really have an answer to that. Maybe you're segregating some items of that income, but something to consider.
Okay, and then in addition, the proposed regulations include some de minimis rules that can apply when a trader business has a mix of good qualified trader business income and quote bad service business income. And I think, yeah, on the slide, if a trader business has gross receipts of $25 million or less, and less than 10% of the gross receipts are from the service business, everything's okay. The service business won't taint the qualified trader business. There's a little bit different threshold for larger businesses. If the trader business has gross receipts greater than $25 million and less than 5% of the gross receipts are from the service business, it's the same result. The service business won't taint the qualified trader business. Begs the question, so what if we have an LLC, as shown in the diagram, that has, say, 70% of its gross receipts from a good qualified trader business and 30% from a service business? Well, if that LLC is considered one business, are we out of luck? Or do we allocate and apportion the QBI? We're in that murky middle where we look at facts and circumstances, I think, from what Adam said. But we also are not positive, based on the proposed regulations, what position the IRS will take, whether they will even tolerate that sort of a mix. So depending on the facts, I think the planning opportunity might be that it may be possible to argue that we actually have two separate trades or businesses. We might show that by having separate employees, functions, books, and records, that we can support separate trader business activities. Also, as Adam mentioned earlier, we may want to actually segregate the activities into disregarded legal entities, even using single-member LLCs or qualified Subchapter S subsidiaries to help separate those businesses. My personal sense, and that's all it is, a personal sense, is that separating the activities into two or more trades or businesses, if possible, is really the right answer, but it's certainly unclear whether the IRS agrees with that. In fact, a number of commentators say the IRS doesn't agree. So we'll see. Adam, you're going to do crack and pack?
Yeah, we'll do crack and pack quickly. We're running out of time, which was our worry. There's too much good stuff here to cover. But there was an idea put out there by some commentators over the last 6, 7, 8 months that you could do what's called a crack and pack. And the idea being is that you could take a law firm and split it up. It doesn't have to be a law firm. You could take a service business and split it up into its component parts to generate some good income. So if you use the law firm example, for instance, commentators are suggesting you should be able to crack open the law firm, pull the real estate out, pull the administrative functions out, pull everything out that could generate good income, crack the law firm open, pull those parts out, and then pack the good parts into a separate entity, separate from the lawyers, and then generate good income from that. So this was put out there. You know, some of it was people were trying to generate buzz when they write articles. I mean, I think some of it, some people thought actually this was going to legitimately work. And not surprisingly, you know, I make the comment out there that if you have a great planning idea and it's borderline abusive and you publicize it out there before the IRS issues regulations, it's probably not too surprising that the IRS in its regulations is going to clamp down on that idea, which is exactly what the IRS did to the crack and pack strategy. So there's an example here on the slide of a law firm tried to do exactly what we talked about, that they originally had everything in single entity. They tried to put the building into a separate partnership and then the admin functions into a separate partnership, separate from the legal services, to generate good income from P2, the building, and P3, admin. And what the rules say is no, If you have common ownership, which is the law firm owners, and there's interrelatedness between all of this, so that the building's used by the legal practice and the admin's used by the legal practice, the IRS says that's just one business, that's a service business, your income doesn't qualify. To me, the result's not surprising. There's been some people out there that have maybe feigned surprise that this is what the IRS came up with. I think if you were telegraphing that you were going to do this, it's just not surprising the IRS that this doesn't work. So it's, if you were thinking about cracking and packing, if you have a doctor practice or a law practice or an otherwise not qualifying business, it's going to be difficult to really pull things out of that business to generate good income. And
there's another de minimis type rule included in the proposed regs that applies kind of the reverse of what we just talked about. When a service business has a small amount of, and it's 5% or less of good qualified trader business income. In this case, the good qualified trader business income is treated as incidental when it's at 5% or less to the service business, and it's disregarded. There's an example, of that. I'll try to just very quickly. We have a dermatologist provides services through an LLC. That LLC also sells skincare products, uses the same employees, office space for both activities. Under the facts, the gross receipts from the skincare product don't exceed 5% of the gross receipts of the LLC. So under this incidental rule, the sale of the skincare products that normally would be viewed as potentially good trader business income is not treated in that fashion and won't be treated as and broken out as qualified business income. Open question, of course, is what if the skincare products were 10% of the gross receipts? Would that activity arguably be a separate trader business that could stand on its own, maybe generate some good trader business? While we think that might be the correct answer, well, again, we don't know that the IRS buys that.
Yeah, it's a curious example. I mean, Mac and I and some others at Eide Bailly were, when these regs came out, talking about that, because in the first de minimis example, it says more than 10% of your gross revenue comes from service. It taints everything, meaning even though 80% of your income or 85% of your income comes from a good source, the 15% taints it. This example seems to say the exact opposite, that if you have, if more than a de minimis amount of your income comes from a good business, if you have a service business and more than de minimis comes from good income, which is the sale of products here, the good income is not tainted. It's just treated as a separate, seems to hint that it's treated as a separate trader business. So it's interesting. We're not sure what, you don't know whether to read too much into it or what the IRS is getting at, but those are two very interesting examples to contrast and compare. Quickly here, we'll move through this quickly. It's not unlimited, the 199A deduction. This is a little bit of a recap, but as Max said, you need to pay wages, and if you don't pay wages, you can look to your qualified property for purposes of determining your limitations. And we'll get to it in a second. The regulations provide some helpful details on this, but first to our third polling question, have you discussed section 199A with your return preparer or another tax professional? Yes, no, not sure, not relevant.
Just a few more seconds on the open poll there. Okay. And you should be able to see.
Interesting. So, about half and half. I mean, 46% of people have talked, 45% of people have not. And then a few people not relevant and not sure. So, I mean, the people that said no, I think we would strongly recommend, hopefully it's an Eide Bailly, hopefully you're an Eide Bailly client, but even if you're not, I mean, whoever does your tax work or advises you on taxes, I think it would be very advantageous to go talk to that person before the end of the year, before busy season, just to talk through. It's obviously, it's a very complicated statute and a very complicated reg package. So it could be advantageous for everyone to meet with their tax professional. So I talked about there's the W-2 wage limitation. The proposed regs track the former domestic production deduction DPAD rules, former Section 199A. The former rules say that there was a question about what if you use a common paymaster. So let's just say you have 7 or 8 different related businesses, and for efficiency purposes, you use one entity to pay all the wages for those various businesses. What happens? Because technically those other businesses are not paying wages, and can those other businesses use the wages paid by the common paymaster for purposes of the limitation? Helpfully, the IRS says yes, you can do that. And then also I'd emphasize it's another reason to aggregate. If you have a mixed match of wages, if you have too many wages in one entity and not enough in another, if you're able to aggregate, that's a reason to aggregate. And this example shows it here that professional employer organizations, these are third-party businesses that you can pay that will do your payroll for you. So they'll issue the W-2s to your employees and so forth. Technically, your W-2s come from this PEO, not from, in this example, doesn't come from business A, business B, or business C. But what the IRS says is that as long as business A, business B, and business C are quote unquote viewed as the common law employer of the employees, you can apportion those wages to each of those businesses, and that can flow up to the owners for purposes of applying the W-2 wage limitation test. Also, we won't get too much into it here, but also helpful guidance on how to determine your basis, the unadjusted basis immediately before acquisition of qualifying property. This is the alternative test. Generally pretty helpful guidance for how you determine that if you're applying the 2.5% test. Here's a quick example of, just don't forget, even if you've done all of the QBI gymnastics that we've just gone through today, that you've danced the dance and figured out that you have QBI and figured out that you have enough wages and all that, there's kind of a final hurdle to get over that says you have to look to your taxable income and take 20% of your taxable income and back out capital gains and qualified dividends. And if that number is less than your overall QBI deduction, then your QBI deduction is limited. And we have an example here that you can look at if you have time, but it just shows the effect of that. A ends up with 10% of A's, or 20% of A's taxable income is less than A's QBI deduction, and so A's QBI deduction is limited.
You know, a question, Adam, that came up before the release of the proposed regulations was what to do if a trade or business generates a negative QBI and then other businesses generate positive QBI. The provision that was shown on that prior slide really tells us to just simply allocate the negative QBI to the trades or businesses with positive QBI proportionately. And that's what this example basically shows. And again, I think we just let people take a peek at that.
Yeah, back. So a couple of things here, we're wrapping up here, but the deduction does not, if you're a partner or an S corporation shareholder, the deduction does not reduce your basis. Also, it doesn't reduce your self-employment tax. It's allowed for alternative minimum tax purposes. It doesn't reduce the net investment income tax under 1411. And that also, we should be careful here because the Congress introduced an increased accurate or enhanced accuracy penalty that kicks in at a much lower rate. So if we end up with an IRS adjustment from 199A, we can get penalized for it at a much lower rate than other parts of the code. Fiscal year entities generally qualify. Fiscal year entities who have tax years that straddle December 30th, 2017. All of the income potentially qualifies for this. This was a question because the portion of the fiscal year's entity that falls before December 31st, 2017 doesn't align with 199A's effective date. 199A's effective date is for tax years beginning after December 31st, 2017. But taxpayer-friendly rule from the IRS that says it works. You still have to pay attention to the wage calculations are generally look to the calendar year rules, so there may be some matching up to do there. But overall, a good answer for fiscal year entities. if you have.
Real quick.
Yes.
Can we go ahead and launch the last poll question? Some have to run to another meeting.
Yeah.
Awesome, and then we can come back. Okay.
All right, we'll get to our last polling question there. Do you expect tax compliance costs to increase as a result of Section 199A? So are you going to be paying your accountant more money to be doing your tax return to comply with 199A?
Just about 10 more seconds on the poll there, and we'll close it up. Okay, there's the results.
So interestingly, so most people do expect costs to increase as a result of 199A, not surprisingly, especially given the complexities that we've talked about today. And we'll skip a few slides. I just encourage people to look back on that on their own time. But just to wrap it up, that all of this stuff is going to need, all of this information is going to need to be separately tracked for each trade or business. And an RPE, a relevant pass-through entity, which is a partnership or an S corporation, is going to have to separately track each of this. You know, each trade or business, the QBI, whether it's a service business, not a service business, each partner S corporation share of wages and basis, and this is all going to have to be provided on the K1. And I would guess that none of this is being done right now because it hasn't been required before to be done. So I would guess those of you out there that are getting ready for end of the year financials, no one's tracking this. Bailey is starting to do it, but we've never been required to do it before. So it's just a whole new level of complexity there. And to deal with it, I just really encourage people to be meeting with their tax professional, whoever that is, this year to talk about how you're gonna tackle this, because there's gonna be some big hurdles to jump over next January, February, March during the busy season. And then also that we anticipate updates to tax forms and instructions to aid with compliance. We don't have the new 1060, we don't have the new partnership tax returns out. We don't have the instructions out that would give us more details on how to file various elections and how to compute the 199A deduction. So hopefully we'll be seeing that stuff in the next couple of months. These are some of the items we didn't talk about. There's a whole bunch more in these proposed regs that we didn't get to today. We just didn't have time. If you're interested, reach out to us with a question. We also have, here's a listing of a couple of insights we've put out that cover some of those items. The first is an insight we put out last week, kind of summarizing these regulations. And then the second is an insight we put out a month or two back on a planning idea. The idea being guaranteed payments don't qualify for the 199A deduction, but is it possible to instead achieve something similar to a guaranteed payment with a net income allocation, and the benefit being that qualifies for a 199A deduction. So if you're receiving a guaranteed payment or paying guaranteed payments, it may be worth your while to have us or someone else look at your operating agreement to see are there changes we can make to make people eligible for the 199A deduction. So with that, I know we're over time. I just would thank everyone for attending today and for wading through this brand new set of rules with us. And we can stick around, I can stick around to go through these questions. Amy, I don't know, are you able to stay?
Yes, we're good.
Okay. So I thank everyone. If you have questions, please use the chat box, and maybe Amy, if you want to read off the questions, if you can see them.
Sure. Okay.
I can't see them.
No worries. So this goes back to the beginning of the presentation. Just to clarify, is there a threshold limit applicable to the trades of business or specified trades of business? Thinking of an S-Corp construction company. So
the threshold limits we talked about, think about it's not the S-Corp level, but the individual level. If you're married, filing joint, if you have taxable income of $315,000 or lower, you can take the 20% deduction on, if it's a construction business, for instance, you can take the 20% deduction on the income from that S-Corp, whether you have W-2 wages or not, and whether it's even from a service business. The construction business is not a service business, but if there was some service income there, you wouldn't have to worry about it. So that's the significance of those threshold numbers we talked about. If you make under that threshold amount, you don't have to worry about it being a service business, and you don't have to worry about the W-2 wage limitation and the basis and property limitation.
Okay. Does having rental properties fall under the investing or investment management category?
It could, Mac, if you're still on. I mean,
yeah.
It's more. I think the example would be this. Let's say that you are a general partner and you set up a fund and you attract investors, and you say, we're going to invest into commercial rental property. But my role as the general partner is to raise the capital from the limited partner investors, and my job is to deploy that capital in an efficient manner. And I have a fiduciary duty to my limited partners to manage that money appropriately and make sure that we're getting an appropriate rate of return. That is investment management to me, and that looks like a specified service trader business, because typically the GP in that situation is going to get paid a % of capital raised or a % of assets put under management. Now that's different from the GP. There could be a related entity, or there could be someone else that instead what they do is manage the properties, day-to-day manage it. They're not managing the investment, they're managing the properties. You know, making sure that upkeep is maintained, that the landscaping is maintained, that things that are broken they fix. That's more property management, and I think that qualifies. So, Mac, if you have anything to add to that.
Not really. I think that sums it up from my understanding.
Okay. The next question is, what is the logic of excluding all the service industries except architects and engineers?
So that's a good question. So we didn't highlight that point, but architects and engineers actually are the two businesses that do have qualifying income. When tax reform was first passed by the Senate, not passed, one of the versions of tax reform treated architects and engineers in the same way that lawyers and doctors are treated, that they have bad income. Finally, when the final bill was passed, they were cut out from that. Engineers and architects have good income. So the logic, I don't know. People guessed maybe to some extent architects and engineers, you could view them as part of making things and the planning process for making things. And to the extent that that's what tax reform goal was, to reward those types of businesses and industries, maybe that makes sense. But it's hard really to, delineate or come up with what are the, is it pure policy that dictated that, or is it just effective lobbying from the architects and engineers, because they're closely tied to the real estate industry, and the real estate industry is a very powerful lobby up in Capitol Hill, and so maybe that explains some of it too. But it's maybe anyone's guess beyond that.
Okay. What about retired farmers who begin to rent out large amounts of land?
Mac? That's a tough one. I mean, it goes back to Adam's discussion during the program of does that rental activity rise to the level of a trader business? And we've kicked that around a little, and I don't work the ag business side of things much at all, so I might not be the right one to talk about it, but my sense would be if initial reaction from the IRS might be pretty skeptical that would qualify. On the other hand, you might have a set of facts that would show that the retired farmer still keeps an eye on what's going on the property, and keeps the fence in shape, and maybe has conversations with what's going on. I don't know. Don't know all the things that might go on, but certainly start looking into those circumstances and see what expenses the farmer could cover, what he could do to make that, he or she could do to make that look like a separate trader business, including perhaps putting it in a separate legal entity, even if it's disregarded for tax purposes. Adam? What would you add?
Yeah, I think that's it. I mean, it's a great question because it probes, you know, there's kind of a continuum or maybe just a large gray area. You know, on the one side, you're pretty sure what qualifies. If you own 50 pieces of property and actively manage them all and they're not in triple net leases, you're gonna feel pretty comfortable that's a trader business. And on the other side, you know, if it's just a single piece of property, you don't do anything, it's a triple net lease, all of your time is spent doing something else, and all you do is collect a check, maybe that is not a trader business, but then there's just big gray area in between. And I think what you do is you meet with your tax advisor and say, what good facts can we highlight here to get comfortable with at least taking the position? And it may if you get audited, it doesn't mean you're going to win, as Max said, but at least can you develop enough facts, you know, facts and circumstance, can you develop enough of a facts and circumstances argument to take the position on the return? So that's as much as I got.
Okay, the next one, I think this is more of a statement than a question, but presumably if a rental is a business, there are a host of local and state tax issues. This could be tripped up as well. Seems very messy.
Yeah, I mean, it's I think, you know, if anytime a new code section comes into play, and we haven't had, I mean, Mac is more experienced than I am, and I've never had anything like this in my career come out. And so anytime there's a wholesale change to a particular area, it's going to have a bunch of effects in related areas. And so there could be estate planning that made sense in their prior law. Maybe it makes less sense now. You know, maybe the estate planning still makes sense, but maybe from an income tax standpoint, things have changed with 199A. Same thing from a state law perspective. I mean, I don't know any thoughts beyond that, but it's not surprising that people could have well-laid plans and suddenly those plans look less desirable, or maybe that they're not as, they don't place someone in as an advantageous a position as they'd like to be for purposes of 199A.
Yeah, Adam, not to date myself too much, but when the passive loss rules came in 1986, I mean, it took years for things to settle in and people to start to realize the implications not only of those rules, but the effect that had on all sorts of other tax treatments. And so an example might be, you know, if you've got qualified trader business income, but it's you're running up against wage or qualified property limitations. Some people have talked about, oh, well, maybe if you can put up to $157,000 of income into a trust, for example, then at least that trust would be free of the limitations, because it would be below, the income would be below, the taxable income would be below the threshold, and perhaps there would be ways like that as well to pick up an extra deduction. Certainly our rules in these proposed regulations to prevent using 5 or 6 trusts to try to replicate that over and over again, but there may be opportunities to use a trust. So all sorts of thinking, I think, going on out there right now on how to make all this work and how to get the best deduction.
Okay, we have about 8 more questions, so try and get through these. Oh, sorry guys, we have construction going on. Okay, every time I unmute, I'm afraid they're going to start construction. Okay, the question is, if we hire a property management company to manage townhomes, would it be a business or an investment?
Well, you don't know. I mean, on the one side, if you hire a property management company, you could say that's a bad fact because it looks better to be involved directly in the business versus hiring someone else to do it. But on the other side, there is a case, I think, Mac, or there's something that either an IRS ruling or a case from 20, 30 years ago where someone was held to have a rental property trader business, even with the fact that they hired a management company to kind of manage the property. So you'd want to look at what else is out there. Just the mere fact of a management company could be a bad fact, but do you have anything else? What other facts and circumstances could you show or develop to get over the trader business hurdle?
Yeah, it may not be a stake in the heart, but it's not a helpful thing necessarily for purposes of 199A.
Yeah.
Okay, if you're under the income threshold, does the W-2 wages requirement still apply?
No. Yeah, correct, no.
Okay, would aggregation ever hurt you?
So people have brainstormed on this. I haven't come up with an example yet of how aggregation would hurt you. It's a great question, because aggregation can help you, obviously. And could you come up with circumstances where it hurts you? I'm sure we'll see it eventually. I have not thought of the fact pattern yet where it would hurt you.
I actually saw an example, but I'd be hard pressed to tell you what it was. But I think there are certainly isolated circumstances, and it just gets back to everybody. There's no substitute for running the numbers on this stuff, and you can generalize all you want as far as at an S corporation or partnership level on what the QBI is and what the limitations are, but you really don't know the result until you push it on down to the individual level and walk through and compare aggregating versus not aggregating. And I think one point that maybe we didn't bring out too strongly, but you can pick and choose in your aggregation. You don't have, if you've got 3 businesses, you don't have to aggregate all 3. You could aggregate 2 and leave 1 out. So you've got this massive permutations and computations that you could go through and to try to determine what is the best thing, not only for this year, but in future years.
Okay. With privacy and ethics concerns, especially regarding identity theft, can we even allow information about share or entity ownership to be disclosed in that nature?
Yeah, I think so. I mean, you're not going to be putting all of the sensitive information is already on the K-1, because you already have the taxpayer's name, address, and social or EIN on the K-1. So that would typically be the information you're worried about for privacy concerns. I mean, the information we're putting on there is more, the S Corp or the partnership had 3 trades or businesses, trade or business 1, 2, 3, here's the income from each, here's your share of wages from each, here's your share of basis from each. So I don't think, and if I'm understanding the question right, I don't think, it's not so much a privacy concern, it's more just a hassle or an administrative hassle, or just there's a bunch of additional work that's going to have to be done that is not being done now to properly report all of this information up to the owners.
So it seems that Matthew is the one that asked the question, and he said specifically asking about the other owners when they discuss minority owner claiming aggregation.
So that's a great question, because if they don't know, if the majority owner doesn't want the minority owner to know for some reason that the majority owner is there or how much the majority owner owns, it's a great question. And it's not answered by the IRS. So, I don't know the answer to that question. If some covenant in place, or if the majority owner tells the partnership, I do not want my identity revealed, I don't want it revealed that I own 80%, then I suppose the minority partner wouldn't know and they couldn't aggregate. But that's a great question, and we don't know the answer to it.
Okay, thank you. So say a person is equal shareholder in an S Corp but receives nothing other than the dividends from the Corp to pay their reported income and not actively involved in the business. Is this person eligible for the 199A deduction?
They could be, so it doesn't matter, they don't have to be active, or it doesn't matter if they're active or passive in the S Corp for purposes of 469. It would really depend on the ultimate source of that income, that dividend, that it's really the distribution coming up from the S Corp. What's the source of that? If it's a qualifying trader business, then the source should follow on the K-1 up to the shareholder. Yeah,
and by the same token, Adam, I presume, if this isn't a good example because legally it couldn't happen, but if I as an accountant was a owner of a doctor's practice, and then the other owners were doctors, at the doctor practice level, you'd say, well, that's service business income, and so, you know, potentially no deduction for anybody over the income threshold, but it would still be service business income to me. It does, you know, that's determined, I think, at the entity level, and you know, I wouldn't be able to say, well, I'm not involved in the business, so that's good income. I can take the 20% deduction on.
Yeah, it's exactly right. It's a source. It's really the source of the income is what matters, where it came from. It doesn't matter so much who receives it. I mean, that could matter when you determine the limitations, but who receives it's not going to change the character of it from QBI to non-QBI or from non-QBI to QBI.
So it puts a big burden on the entity to identify what's QBI, what's service income, whether rental income qualifies, and that sort of thing, as you pointed out.
Okay, so this is just to double check, service industry business income is fine if it's under the income threshold.
If the taxpayer receiving the service income has taxable income under the threshold. So you could get, I mean, conceivably speaking, you could have a law firm partner receives a K-1 with $300,000, I mean, let's pick a bigger number, with $400,000 of income on the K-1 from the law firm. That partner is going to put that on their own return if they're married filing joint, if the spouse doesn't have any income, and if they claim their mortgage interest, their charitable deduction, their 401k, all the different deductions you can claim, and that reduces their taxable income down to $315, they could get the full 20% deduction on the $400,000 of income from the law firm. Now, in that situation, they're going to be subject to the taxable income limit because their taxable income will be lower than the income from the law firm. But the test is at the individual level.
Right. And it's interesting when you do the calculations and say, what's the benefit of that extra contribution deduction that brings me from $415,000, say, down to $315,000 in a joint return to get my taxable income down to the threshold? It's like a 60% tax benefit because you not only save taxes on it, but you get at least salvage a portion of that $199A deduction. So a lot of planning opportunities.
Okay, let's see if we can get these next couple in within about 4 or 5 minutes. What about management companies for large businesses, providing payroll, HR, etc., in relation to the SSTB?
So would the management company be a service? So I'm assuming the facts are that there's a large business that owns a management company, and the management company is providing these payroll services to the other related entities. Would that be a service business? Now, one thing to look at is I've seen in the past, oftentimes those are C Corps, those management companies, and so the C Corp, it's not going to qualify anyway for the 199A. And then I've also seen it where typically the income and expenses kind of net out on the management company side so that there's no positive income. But if it did have positive income, I don't know, Mac, would that be considered accounting services? Maybe it could be wrapped up into the definition of accounting services, maybe.
Could be consulting. I mean, it would just have to sort through that and see, really understand what the circumstances were. And then if there were wages paid there that were apportioned off to other entities, then you wouldn't be able to double count the wages, so you might run into wage limitations too. So.
Okay. This one says, going back to the example of a dermatologist, isn't health an excluded income, so it wouldn't qualify?
That's right. The example says the dermatologist owns a single LLC, and I think, is it a partnership, Mac? I can't remember in the example if it's
taxed as a partnership, yeah, okay. LLC, yeah, taxed as a partnership.
So it's a single entity, and he does two different things under the entity. One, he provides his dermatologist services, which, correct, are medical services and don't qualify. So the income he earns from that doesn't qualify for the 20% deduction. But in the same building and owned by the same LLC, he also sells skincare products. And I think the inference from the example is that you could walk in off the street and buy the skincare products. You wouldn't have to buy his skin doctor services. You could just buy the lotion or the sunscreen or whatever it is that he sells independently. What the example seems to suggest is that if the income from those sales of products is more than a de minimis amount, that's a separate trade or business and could generate good income because it's not related to his medical practice. It's an interesting example though, because there's a single LLC that owns both businesses. They share the same premises and they share the same employees. So it's interesting that the IRS doesn't say, but it seems to infer that the products could be a separate business if it is more than a de minimis amount of the gross revenue.
Okay. When calculating the W-2 wage limitation in an S-Corp, can we increase owner-officer's salary to maximize the deduction?
Well, so let me take this question in two parts. Owner-officer wages do count towards the W-2 wage limitation. So if you're a wholly owned S-Corp, you own it yourself and you get a bunch of income from your S-Corp, you can include the W-2 wages you pay yourself as part of the test. Now, the amount of wages you pay is based on a reasonable compensation standard. The standard is not pay yourself enough to maximize the 199A deduction or pay yourself enough to maximize another tax benefit. It's supposed to be reasonable compensation, whatever that is. So there's no doubt a range of what reasonable compensation is, and there's no doubt that people are going to be, if they're within that range, they're going to be choosing a number that maximizes their 199A, but you're going to want to be careful, depending on how much money is involved, because of these increased penalties. You're going to want to be a little careful with paying making a large change to your wages just on the basis of maximizing your 199A. You're going to want to have something to point to that says this is a reasonable salary for what I do.
And keep in mind the wages don't qualify for the deduction, and so you're trying to find that middle ground where you can get a good non-wage income, distributable income from the S corporation that qualifies, but recognizing you have wage income that won't qualify.
That's right. The wage income decreases your QBI.
Yeah.
The wage income is included in the limitations test, but it decreases your QBI. So there's a magic number somewhere there.
Alrighty, last question. It seems that businesses are going to have to provide a ton of information, whether it will ever be used or not, because each individual's tax return is actually what matters.
I think that's exactly right.
Yep.
That was our,
exactly.
Whoever asked the question.
Summed it up really good.
That's exactly, I couldn't have said it better than myself. You just don't know. I mean, you don't know, even if you're a service business, let's say you're a service business and have non-QBI, you can't just say, well, it's all non-QBI, we don't have to worry about anything, because you could have owners that are under the taxable income threshold. So you're still going to have to tell them what income is from a service business or what income is from something else.
Awesome. Well, that's the last question I have on here. So thank you guys so much.
Well, thanks to everybody for sticking around.
Yeah, great. Good questions. So thank you.
Okay, well, we will get the recorded link of this webcast out here within the next week. And if you guys have any questions, feel free to reach out. Have a great day.
Thank you, Amy.